Okay, so we'll discuss 2018, the second paper, question number 1, from company final accounts. I'm going to explain the PPE adjustment, right? So if you take the question, 2018 question, there are 12 additional informations. So from those 12 additional information, number 4, number 5, 6, 7 and 8. So 5 adjustments are related to PPE, right? Out of 10, out of 12, 5 adjustments are related to PPE. So you can see the importance of the PPE adjustment, right? Okay, so let's start with adjustment number 4, 5 and 6, right? So we need to draw the statement of PPE. There are 4 assets: land, building, motor vehicle, office equipment, and we need to have the total column. So this side, this is the cost and this is the accumulated depreciation. So remember, this is also similar to the ledger account. In ledger account of asset, here you have debit side and this is the debit side, increase, and this is the credit side, which is decrease, asset. So same thing, we will add. If it is debit, we will add. If it is credit, we will deduct. And accumulated depreciation, credit entries will be added, debit entries will be deducted, right? So we'll move on to the adjustment. We'll start with land, adjustment number 6, right? Workings. Working number 1, I'm going to do adjustment for the land. So what has happened to the land? The land of the business was revalued for the first time on 31st March 2015 for 25,500. The land was revalued on 31st March 2018 for 19,500,000 for the second time, and it has not yet been accounted for. So if you take the financial year, if you draw the timeline, land was revalued first on 31st March 2015, on 31st March 2015, and 31st March 16, 31st March 17, and we are in 18. This is our financial year. This is our financial year, right? So the first initial revaluation, is done on 31st March 2015. So the revalued amount is 19,500. Sorry, 25,500. Initial revaluation is 25,500. Then the subsequent revaluation on 31st March 2018, end of the current year, subsequent revaluation on 31st March 19,500. Right, and they are saying there is this revaluation 31st March 2015. The revaluation profit has been transferred to the revaluation reserve account. Right? It says so if you check the trial balance, since already the revaluation was done 31st March, there is a revaluation profit which was credited to the revaluation reserve account. So you can see there is a revaluation reserve account with a balance of 5,000. So that means at the initial revaluation, there is a revaluation profit of 5,000. Valuation profit. So can you all guess the cost of the land? Cost of the land. If the revaluation profit is 5,000 and the revalued amount 25,500, what is the cost of the land? So that means land has increased by 5,000. So cost of the land is 20,500. Cost of the land is, that means 31st March 15, we had a land worth of 20,500, revalued at 25,500. The revaluation profit is 5,000. So that is initial. This part is done. Accounting is done for this. Double entries are recorded. Now, subsequent revaluation. So what you need to understand here is, when there is a subsequent revaluation, what is the accounting treatment? So let me explain the subsequent revaluation. So initial revaluation, initial, it can be a profit or a loss, right? So when you initially revalue, if it is a profit, what's the double end? Let's say land, we had a land value of 1 million, right? You revalue the land, then revalued amount is 1,500. Then if it is a profit, land value increase. So asset account will be debit and it will be credited to revaluation reserve account. Revaluation reserve account credit, right? If it is a loss, then what do you do? If it is a loss, we have to consider it as an expense. Then income statement debit and other expense, income statement debit, asset account credit. Income statement debit and the asset account credit. So that is initial revaluation. Then if you take the subsequent revaluation, so initially if you had a profit, initial is profit, then subsequent it can be a profit or a loss. Can be a profit or loss. If it is a profit, same adjustment, same double entry. If it is a profit, asset account debit, revaluation reserve account credit. If it is a loss, what do you do? Now, similar to this example, if it is a loss, up to the revaluation reserve, up to the amount you transfer to the revaluation reserve, you have to debit the revaluation reserve account. Any additional amount should be transferred to the income statement. Now we'll take this example. Okay? Right. We had a land with a cost of cost of 20,500. We had a land with a cost of 20,500. So initially they had revalued. Revaluation. Okay. 25,500. So the double entry was done. 5,000 land account debit. Revaluation. And revaluation reserve account was credited 5,000. That is why in the land account you have 25,500. In the land account you had 25,500. Okay. Then now subsequent revaluation. Now we are here. Subsequent. Now the subsequent revaluation says it is 19,500. 19,500. It is a loss. Now from 25,500 we are going to reduce up to 19,500. So what can you do now? What's the difference? The difference is from 25,500, 19,500 means 6,000. 6,000. So loss is 6,000 now. So how do you record that? Since already there is a revaluation profit of 5,000, you have to debit the revaluation reserve account by 5,000. So you set off the revaluation profit. Then the remaining 1,000, you have to take it to the income statement under other expense. Income statement under other expense. And the land account should be credited 6,000. So land will reduce by 6,000, revaluation reserve will debit 6,000, so it will set off, and under income statement, other expense will have 1,000. So double entry. Let me write the double entry for this. We write the double entry for this. Revaluation reserve account debit. $5,000. Income statement. Debit 1,000. Then land account. Credit 6,000. Okay. And if you are writing it in the statement of PPE, land value was 25,500. Land value was 25,500. Then revaluation loss is 6,000. Okay, this is 19,500, and the book value is 19,500. Okay, so that covers the land. So let's move on to the next asset. The second asset is building. Number 2, working number 2. Let's do building. The construction of a new building costing 4 million was completed on 31st March 2018, and the adjustments related to the new building have been properly accounted for in the books. Right, so let's check the building cost. So they have building 28,000. Building is 28,000. there is a new construction of the building which is 4,000. New construction of the building is 4,000. Then what was the old building? This was recorded properly. In some questions you might get this as not recorded. But here all the depreciation and the constructed building, everything is recorded. Completed on 31st March 2018. Right? So all building value is 24,000. Even though they have recorded, we are taking the final amount is this. We are taking the final amount as this. But when you are showing the statement of PP, you need to show separately the purchases or additions and the depreciation of the current financial year. So new building, we don't depreciate. No depreciation. But the old building, you have to depreciate at 5% for 12 months. So 24,000 into 5% is 1,200. So that's the total depreciation of the building. So when you are recording in the statement of PP, the opening balance should be 24,000. Opening balance should be 24,000. And additions will be 4,000. Total 28,000. That's the total building. Then the accumulated depreciation. Current year depreciation we have calculated. Current year depreciation is this 1,200. And also they have given the closing depreciation. Building accumulated depreciation is 8,000. That's the closing after recording the current year depreciation. Therefore, the opening balance will be 6,800. So net value is 20,000. 20,000. Right. Then we'll move on to the next adjustment, which is motor vehicle. So motor vehicle, there is a disposal. Working number 3. Motor vehicle. Right. So what is the adjustment for motor vehicle? A motor vehicle costing 2,500,000 was disposed for 1.5 million on 31st March 2018. This motor vehicle was purchased on 1st of October 2016. This disposal has been properly accounted for, and the loss on disposal of the motor vehicle has been recorded under distribution cost. Right. So first you need to identify the motor vehicles. So the total cost of the motor vehicle 16,500. 16,500. And also this has been properly accounted. That means this doesn't include the disposed motor vehicle. So this is the remaining vehicles. This is the remaining. And the disposed vehicle cost is 2,500. 2,500. So total at the beginning of the year, this company had a total of 19,000. They had 19,000 worth of vehicle. Disposed 2,500, remaining 16,500. Right? And if you calculate the depreciation, you need to have the previous depreciation and the current year depreciation. You need to calculate the previous depreciation and the current year depreciation. So for the disposed motor vehicle, it was purchased on 1st of October 16. Previous depreciation means from 1st of October to beginning of the current financial year, 1st of April 2017. And the current financial year starts from 1st of April 17, and this was disposed on 31st March 2018. So you need to know the time period. So how many years and months we have used this motor vehicle? So 1st of October to 1st of April 17. How many years? 1st of October 16 means October, November, December, Jan, Feb, March. Then 6 months. Previous, right? 1st October to 1st of April. That means 31st March. And here is 1 year, 12 months. Current year we have used it for 1 year. So total, if you take from 1st of October 16 to 31st March 18, 17, 1 year, then there is another 6 months. Right, so let's calculate the depreciation. 2,500 into depreciation rate for motor vehicle is 20% into 6 months. Then 2,500 into 20% into 1 year. So 250, this is 10%, and 20% 250, 500. So total depreciation of the disposed motor vehicle is 750. And if you take the remaining vehicles, 16,500 into 20% into 1 year, that's the total depreciation. Total depreciation of the remaining vehicle for the current financial year, it's 3,300. So if you want to get the current year, this is current year. If you want to get the current year total depreciation, it is 3,800. 3,800. Okay? Right. Now you need to do the disposal adjustment. So remember, for the disposal adjustment, motor vehicle disposal, there are 4 steps. For a disposal, you have 4 steps. First, you transfer the cost, then transfer the total depreciation, then the sales proceeds, then profit or loss of the disposal. So you need to follow these 4 steps when you are transferring, when you are calculating the disposal profit or loss. So number 1, the cost of the motor vehicle disposed is 2,500. So that will be deducted from the motor vehicle account, 2,500. 2,500 will be minus. So opening balance, you need to remember, it is 16,500 plus 22,500. So opening balance was 19,000, disposed 2,500, then only we get a balance 16,500 as the closing balance. Then the second adjustment, second one, the total depreciation of the disposed vehicle, that is 250 plus 500, 750. So that is disposal. 750 will be minus 2,500, 200, 50. And also we can write the current year depreciation. Current year depreciation we have calculated, it was 3,800. Current year depreciation was 3,800. Then the sales proceeds. So sales proceeds of the disposal, we have received 1,500. Credit and cash account is already debited, and the disposal profit or loss can be calculated by balancing the account 2,500, and it's a loss 750 plus 1,500, 2,250, and the disposal loss is 250, which was recorded in the distribution expense. The disposal has been properly accounted for, and the loss on disposal of the motor vehicle has been recorded under distribution expense. So you have to deduct 250 from distribution expense, from the distribution column, minus 250, and take this into other expenses. Okay. So when it comes to the statement, what is the opening balance? So since all the double entries are done correctly, the motor vehicle accumulated depreciation is 4,500. So you can calculate the opening balance. So you have to go upwards. 4,500 plus 750 minus 3,800. That means the opening balance of the motor vehicle provision for depreciation is 1,450. So 16,500 minus 4,500 is 12,000. So that's how you record this. Then let's move on to office equipment. So what do they say about office equipment? We had land, new building, motor vehicle. There were no other additions or disposal of property, plant and equipment during the year. So no any other additions or disposals. So working number 4, office equipment, cost is 10,000. Depreciated 10%. So no any other adjustment. So current year depreciation is 1,000. So what you can do is, since no adjustments, opening balance is 10,000, closing balance is also 10,000. Depreciation current year is 1,000, and the closing balance of his equipment is 2,000. That means opening balance to go upwards, then it's 1,000, this is 8,000. Then you can calculate the closing balances. Cost of all the assets, 19,500 plus 28,000 plus 16,500 plus 10,000. 74,000. You need to get this. Then the accumulated depreciation 8,000 plus 4,500 plus 2,000 is 14,500. Then 74,000 minus 14,500 is 59,500. Right? So you can do the PPE statement of PPE in this method.